Australian mining companies have performed strongly this year, led by coal, gas, oil and iron ore producers. Business reporter Edward Boy recaps a volatile year for the resources sector.
Energy markets suffered major disruptions in 2022. It all began when Russia invaded Ukraine at the end of February. Countries in Europe imposed sanctions on Russia and agreed to stop buying coal, oil and gas from Russian companies. And this pushed up commodity prices.
Just a few days before this conflict officially started, we have received a number of phone calls, dozens of phone calls out of European customers that we know and European customers we don't know.
Coal was one of the biggest winners. The price of metallurgical coal used for steel making jumped from about $400 a tonne up to about $700 a tonne within a matter of weeks. And thermal coal used for electricity generation spiked from about $250 a tonne up to $450.
Well, it's over $400 US, which is quite extraordinary. That's obviously indicative of a very, very tight market. And as I say, customers trying to bring coal forward, so demand is very solid.
But it wasn't just coal that performed well. Russia is also a major oil and gas exporter, and with Russian supply being cut, Aussie companies cashed in.
The market is tight. There's been underinvestment in the sector globally. And you know, as nations come out of the pandemic, there's a lot of desire to get economies moving again. Demand is going up for our products. But again, you know, you pull the crystal ball out and there's a lot of talk of recession. There's questions about what's going to happen in China. So we're at a point in time where there's tremendous uncertainty.
China's COVID-0 strategy was another major disruptor for energy markets. Entire cities across China were regularly placed into strict lockdowns, shutting factories, ports and steel mills. And this caused the iron ore price to fall from about $150 a tonne in May to a low of about $75 a tonne in October.
We have this complementary relationship between Chinese needs and Australia's ability to meet those needs through the resources sector, and we've all benefited from that. Now, in terms of a business to business perspective, we continue to have great relationships with our Chinese customers and suppliers. We procure quite a bit from China as well.
Gas prices also rose sharply this year, adding to inflation, which caused politicians, economists and members of the media to question why prices were so high. Gas companies say the problem was a lack of supply.
The last decade or so, we've not been able to bring any new projects on, any new gas fields on in the East Coast as a consequence of moratoriums, bans on gas in Victoria, for example, and just increasing green and red tape preventing new projects coming to market.
The high price of gas on the East Coast caused the federal government to step in and place a price cap on gas for the next 12 months.
The truth is that a $12 price on gas, a ceiling if you like, is something like 96% of gas contracts, deals that were done in 2021 were for under that. And the average price was under $10.
And while mining companies were cashing in on the higher commodity prices, they were also looking at ways to decarbonise.
If we do nothing, by 2030, we'll be chomping through 1 billion litres of diesel a year, plus gas. You're looking at $1.5 billion in fossil fuel US dollars. They're just getting smoked into the environment. You've got nothing to show for it. We take that, we invest it into energy, into equipment, into beautiful facilities which will last for 20, 30, 40 years. And we have eliminated fossil fuel with a one-off investment of $6.2 billion.
Commodity prices are expected to stabilise next year, but the big question is, will China reopen its economy? If it does, then you can expect stronger demand for iron ore, oil and gas. And that means strong performances from some of Australia's biggest mining companies. Edward Boyd, Sky News.